time to come to our meetup this evening. It's always good to see all the returning faces along with all the new faces. So yeah, today we're going to be talking about how to buy a cash flowing property in today's rates. Before that, we'll just cover a few things. So we are the organizers. I'm Santhosh, this is Anthony, and Layne Walters is a mortgage broker. Okay, I'll hand it off to Anthony to start off with a market update.
So I'm sure a few of you know how hot of a real estate market we have right now in Calgary. So, thank you. So yeah, I wanted to provide some stats from January. So latest real estate stats we have. And it's really interesting to see because last year, well, almost a year ago now, we did a similar presentation with some market updates. And the months of inventory at that time was 1.45 months, which is very low. In a balanced market, we're typically in the 4 to 5 months, was already low, right? And Layne and I were joking, we're like, I don't think it can get any lower than this, right? Well, it has. It's 35% lower, over 35% lower. So at only 1.3 months of inventory. So that's why we're still having, like we still see lots of bidding wars right now. Anything that's priced well is selling over list, selling really fast. As you can see, the average days on market, which was already fairly short last year, is down by 8 days over January last year. So very fast market. And that is total market, right? So that includes all property types. Some of those are taking a while to sell. So it kind of skews the average, right? A property that's priced well does not take 34 days to sell right now. Property that's priced well, sell within a few days, and then goes conditional for maybe a week or two at the most, right? So, and our median sales price gone up another 10% from last year, which was already up over the previous years. So really hot market overall. And then you can see a bit more in detail, like different property types, right? So it's not all property types that have appreciated the same. Again, all of these property types include all areas in Calgary, and given it's very local, you're not gonna have the same rate of appreciation depending where you're at. But you can see apartment prices have gone up the most. Now, there's a few reasons for that. Condo apartments were the last one to recover from the downturn, right? So they're kind of having the appreciation this year that some of the detached product had last year. Another reason for that is affordability, right? They are the most affordable type of products. And with a lot of out of province investors, a lot of them favor those kind of products too. So, and as you can see, when I said real estate is very local, we have very different rate of appreciation across the city. And all of it is driven by affordability. Because as you can see, the east side, right, the Forest Land over Erin Woods, which are the cheaper areas, have appreciated the most, but they were also the cheapest price, right? Same thing with the Northeast, very strong appreciation this year over last year. So again, affordability and lots of newcomers coming to Calgary has been a big part of that. One that I find interesting is the city center actually started to drop a little bit. So it's kind of plateaued in its appreciation to some extent, at least for now. And something that's really interesting, like I said, the months of inventory, like this was 2019, not that long ago, where it's 6 months, all down to just over 1, right? So huge drop and very fast. As you can see, the prices are still going up, right? And we see that in the market. So it's not like it's stopping as of now anyway. So I'll hand it off to Layne. He's gonna have a bit of a kind of the economic side of the updates. So
yeah, I always look at 3 things that impact real estate values overall as a whole, because right now we get a lot of people asking, prices have gone up so much, is it going to crash? Have we hit a peak now? It just seems unreal to those of us who lived in Calgary a long enough time to realize that these prices are crazy, but we've also lived in a city that hasn't had an increase in price in a very long time. So I always go back, and I've got a relatively large real estate portfolio all in Calgary. So these numbers are important to me. So I'm constantly looking at it. And over the years, these are the things that I've seen as the most important. The first one is affordability. If you're in a market where incomes go up 2 to 3%, but real estate prices go up 10%, and that happens over a long enough time period, eventually the math stops working. Now, there are some cities like that, like mainly Toronto and Southern Ontario cities, have had that dynamic. And it's been over a decade that they've been there with those prices increasing. Part of what allowed that to happen was a kind of a suppression of capacity to build, so kind of artificial regulation that prevented supply. at the same time as interest rates were going from a 5 down into that 2007, 8 real estate price or rates were at the, let's say, 5-6% range, and then they slowly kind of continued to work their way down until, and this was even pre-COVID, rates were in the low 2s, and that allowed people to qualify for more. But then their economy is kind of self-fulfilling as people are continually using the equity in their homes to support their lifestyles. So I think eventually the math stops working. Well, it continued to work for a variety of those reasons. However, it did stop working when interest rates finally went up, because then the incomes weren't enough to make the payments. Now, we're only 40% into the interest rate cycle. There are still a majority of people paying under 3% for their mortgages. Over the next couple of years, the remaining, and a big chunk of people will be going from the lowest of those rates to the highest. So that's where I see the Bank of Canada watching what's happening with rates, and it caps us out on rates aren't going to go any higher than they are right now in terms of the Bank of Canada. They are going to come down. We just don't know how much and exactly when. But affordability is the underlying fundamental that can be off for a long time, but eventually it will catch up, and we have to deal with that. The fact that people eventually have to pay off the mortgages. They can't continue to just refinance to make payments on their mortgage. They have for a decade and a half. It's just not something that's sustainable in the long term. The math stops working with small increases in pay and large increases in prices. So this is one of the good examples of what's happened. So this is 2006. I know this because I bought 2 houses right in this 2006, 2007, the house I live in, and one of my rental properties. And in Calgary, so when we hit COVID here, so kind of in this range, and really we didn't have a huge dip during COVID, but a small one. But if you look at the blue is Calgary. Prices had not changed. So this is a benchmark price. So this isn't an average price. Average is an average transaction, which means that if rates are coming down and people are putting more investment money into real estate or buying more real estate, they can buy bigger houses because rates are coming down, and it's also seen as a good investment. So the average transaction might be at a higher price, but that doesn't mean the average price house is going up. It just means people are buying more expensive houses as new builds have bigger homes. But if you bought the same house and then sold it 15 years later, in this case 13 years later, from this point to here, prices were the same. And this is numerical prices. This doesn't take into account inflation. So effectively, the houses that I bought here compared to here, now I made money on cash flow and principal pay down, but they were actually worth less because inflation drove up the value of everything except my houses. So compared to everything else, incomes, everything else, my house prices actually went down. Now, as with real estate, inflation's good because it actually drops my mortgage just didn't go up either. So with real estate, even when you get it wrong, you just have a longer time period to wait until it eventually pays off. But I guess here's the other comparison though. The important one is Toronto. Vancouver is overpriced and definitely got more overpriced. That's a very steep trajectory. But Vancouver has natural geographical constraints, water and then mountains, right? It's really, really constrained. Toronto is the Greenbelt made up constraints, which they're now being forced to undo by the federal and provincial governments. So they're going to have to fix that, which means there's going to be more supply available. It's going to take years to build that supply because we're behind, but they eventually will likely have less of a return than we are capable of here. The thing this doesn't take into consideration as well is we make more money. So this is just the price. The fact that we make more money makes us even more affordable. Our prices are significantly lower, but we also have the average household income here and median household income here is higher. So I've got the stats, and the only city higher than us, and Ottawa is usually Ottawa Gatineau, so I'm not sure this one actually shows Ottawa at a higher price. First time I've actually seen a higher income level than Calgary. But when you look at all these numbers, so the green ones are the ones where it's affordable to buy. This is how much you are required to buy. This is the average household income compared to the carrying costs on the average priced house. And when you look at it, the only city other than Calgary, the major city other than Calgary that has potential for growth is really Ottawa. But when you compare to, Toronto, most of Ontario, Vancouver, these cities are very, very negative in terms of their capacity. So as they level out to something that makes more sense from an economic standpoint, their prices have to come down or their incomes have to go up substantially through inflation, which will drive the cost of everything up, including our real estate here. So second to that is supply and demand. Now, Anthony touched on that. The supply is so short right now that everybody writing an offer, I can't tell you how many of my clients have been writing offers and just not getting accepted offers. So they're out writing offers. It's like, we got outbid. Okay, we're bidding $70,000 more than this price. We just want to get a house. We didn't get that one either. So that's a story that we're hearing a lot anecdotally, but it's reflected in the numbers as well with the short inventory. So that's kind of the short-term supply and demand. If you're looking for a house and there's 10 people looking, and for every 10 groups of people looking to buy a house, there's only 2 houses available, it's going to really jack up prices. The long-term supply and demand is a little different. It's really about population growth, like how much is the population growing, usually as a result of employment, and some other factors can come into play, versus how many homes or supply that you have. And that's where you've got strong international migration in Vancouver, Toronto, and Calgary as well. But in those cities with a constrained supply, it has driven up their pricing to a point that's not really sustainable. But we're now dealing with that same constraint. We've got the interprovincial migration now. We've got the youngest population, so we have the highest birth rate. So interprovincial migration, I do have a stat on that as well. But I'll talk about, this is our growth. So this is natural birth. This is over the last year. This is the last quarter of last year. This is births compared to deaths. So we have the youngest population. So we have a naturally growing population. Net interprovincial was 55,000. That is a record of how many people are moving from other parts of the country to Alberta. I'll show you some stats on why. It's jobs effectively. Of course, affordability has a big impact on that as well. And this is then the international migration. So this is the fact that Canada's bringing in a lot of people and they're moving to cities. They typically move to major centers. Calgary is now taking we used to get lower than average share. We're now taking a higher percentage of that share of international people. It used to be Toronto, then Vancouver, then Montreal, and then Calgary was a bit of an afterthought, even though we did get a lot of international migration. We're now number 1 for that. So this is last year, just 200,000 new people basically in Alberta. We don't build enough homes for this. So I think these stats where we had to almost 9 times our building pace is the last kind of stats that were measured. We had to build 9 times as many homes as we are currently building. If we can increase our building by 20%, we're doing great, because a lot of tradespeople are retiring and not as many younger tradespeople are getting into the industry. That's a problem across North America, for that matter, but Canada, but also in Alberta. The idea that somehow we're going to keep up to this, we eventually will catch up, but it's going to take some time. Even once this does slow down, international migration is set to slow down a little bit. But I think Alberta is still going to take a higher percentage of that due to it being a great place for jobs and affordability. Yeah, this was only yesterday. This is from the Globe and Mail, a market strategist or a journalist. Basically, so there's no version of reality where housing can be ramped up enough to meet the tidal wave of demand. Basically, our incoming demand is just, there's no way at this point we can keep up, which is, of course, awful for a society. It's great if you own real estate, because it does mean rents and prices are going to increase. So this is the job growth. This is something that we've just seen an immense job growth. We can ignore this. This is kind of rebound from COVID, but look at over the last year and a half. This is kind of the average in Canada as a whole. In this, which Alberta is included in. But when you look here, we're averaging in the mid 3% growth, and versus kind of low to mid 2%. And you can see this trajectory here is towards the end of last year. And this is what's interesting about our growth is we've had this before. We've had where our employment, economy, everything boomed. It was all because of oil and gas. That is no longer the driving factor. One of the biggest irritants that I have from whether it be economic journalists, economists, VPs of banks that I've had discussions with about this, they always have this opinion that, Alberta's doing well. It's just because oil's up. As soon as oil goes down, Alberta's going to crash again. It's like, well, no, our employment, our boom is not from oil and gas. So CapEx or capital expenditures in oil and gas in 2022, 2023 were about the same as they were in 2016, 2017, 2018, 2019. That's the nadir of gas prices over the last couple of decades. We are not building new jobs in oil and gas. Alberta used to be an economy that was driven, or the growth in our economy is driven by the expansion of the production of oil. And what's happened over the last 4 or 5 years, our economy is based on the production of oil, but those 100,000 jobs we lost, most of them in Calgary during 2015-16, those haven't come back. We are now an oil and gas producing province. We're not expanding our production, and the production that we will expand will be incremental and will just be easy to add on because the infrastructure was already built for it. So as we can get pipelines, we'll increase production, but it won't require 20,000 new employees to go up and build up a new plant somewhere, even though Edmonton's got a new refinery they're going to be building. But it's really where our jobs have come, and we did touch on this, I think in our November presentation, is by far the biggest increase in our jobs. So our job growth, which is outpacing the country and has been for a few years, the biggest one was tech. And we're number 12 now in the world for tech industry. And that's to some degree surprising because every city wants to be the next tech city. So how did Calgary go from being probably not even in the top 100 to being number 12? And part of it is oil and gas, especially in the Calgary portion, was highly technical in Alberta. But we had statisticians with math degrees, science degrees, and they already knew how to code because they needed to as part of their job. It was really easy to switch them over into big data or big tech. So we've had a big shift from employees that used to be considered oil and gas, even though they did technical jobs, are now considered high tech because they're working for a company that's primary focus is technical, or fintech has expanded in a huge way. So the majority of our growth, so the biggest portion of our new job growth in the last few years is tech. We're the only industry, or the only city in Canada last year, actually probably one of the only cities in North America, that didn't see a decline in tech jobs last year. There was layoffs everywhere, but Calgary had new tech jobs. So we were adding to it as everyone else is taking away. Our industry, because of oil and gas, is very entrepreneurial, and it's suited well for startups and entrepreneurial type tech, new tech companies. What scared people away in the past was oil and gas was always, anytime there was an oil boom, you couldn't lease a square foot of real estate. You couldn't hire someone to answer your phones for less than 90 grand a year. It became difficult, but those days are long gone, even in the last oil boom that we saw a few years ago, or over the last year or so. We did not see any new hiring. Certainly no growth or very, very little growth, if any, in terms of lease space. So that's gone, and we're starting to see different industries be comfortable moving here for the entrepreneurial, everything from the infrastructure to the tax, the bureaucracy, to just the motivation of the people that live here. One of the biggest evidences of that is this: de Havilland. There was no $17 billion gift to them to move here. They just liked Alberta as a place to do business, so they moved their head office to Calgary, somewhere they didn't really have a presence before. And they're building this just east of the city. I'm sure many of you have heard of this. This is going to have 10,000 people that work at this place. This will be their research facility. This will be their manufacturing plant. They're building their own airstrip. Even though we have 2 giant airstrips, not too far from there, they're still building their own airstrip to do their research and to ship their airplanes around the world. So this is a big deal because this is we're not a manufacturing hub. We're not any manufacturing supply chain hubs, anything. But in spite of that, they picked here to do business because of all the other things they like about Calgary. And
we have no aerospace industry.
Zero. Yeah, there's just nothing that makes sense about it, or manufacturing. We just have technical, entrepreneurial-minded people and a government bureaucracy, tax structure that supports entrepreneurialism. So they came here in spite of the cost to move all of their offices here because it's a good place to do business. And so that's one of the things that really solidifies what is good when medium-sized businesses look to Alberta as a place to do business. They find it's pretty attractive. Yeah, this is just the latest job number. So continuing that trend that we saw in the previous chart. This is new jobs created. So our net jobs were 10,000, which means we lost some part-time jobs or converted them to full-time jobs and then gained some more net on top of that. So we created, which is the opposite. So 37,000 jobs were created in Canada, but most of the jobs were part-time, and Canada as a whole lost full-time jobs. But Alberta specifically was the other way around. We not only gained 10,000 jobs, we replaced another 13,000 or 14,000 jobs with part-time jobs with full-time jobs. So this is likely to continue. Like everything about our economy right now is doing well. There is a presentation from, it used to be Genware, so CMHC's private market competitor, and they're now called Sagen. Their head economist did a presentation late last year, and he's from Edmonton, so he'd be biased towards Edmonton, but he said Calgary has been getting most of the economic growth, and we expect that to continue. Now, he's from Edmonton, but all of their data is suggesting that Calgary is still the place that businesses are moving to and expanding in, and expects that in spite of Alberta being overall better, that it is still Calgary that's likely to receive the continued growth here. So there's going to be a bit of a divergence as instead of cities being the similar size, and Calgary has, again, we've been the ones creating the new jobs. Likely that's going to continue, and Calgary specifically is going to continue to do better and have more growth in both jobs, the different types of industries we have, as well as returns on real estate. Doesn't mean you can't find good cash flowing properties in Edmonton, because you really can. But in terms of overall growth, Calgary is expected to continue to do better. So Alberta is going to do better than the rest of the country. And then specifically, we are getting most of the new jobs. We're getting most of the interprovincial migration as well. So that's the overall picture of kind of our economics, and partly answers the question of like, is it really great to buy in a frenzied time like now? And because sometimes that's a sign that we've hit a peak, but we haven't really. If you look at the chart, our affordability is still just so far below. We have a lot of room to grow. So there's really not, and if oil and gas did drop, and it really didn't impact us, like we're still creating jobs. So oil and gas isn't really impacting us, not to mention with the Trans Mountain opening up, we're probably going to get even if world prices go down, the spread that we get between the West Texas kind of North American price for oil and what we get, Western Canadian Select is what they call it. There's always a big gap between those two. So we sell our oil for really cheap into the American market, and they just upsell it to the rest of the world. Well, now with 3 times the capacity to sell to Asia, it's going to make that spread a little bit small. So even if oil and gas overall comes down, we're likely to still not have a bad return. And the only reason that really impacts us is the jobs thing. It's government royalties. The government does, if the government has a lot of money, it just helps all of us, right? They don't have to increase taxes. They have the ability to spend money. So having government royalties up is never a bad thing. So now we're looking at one of the other questions. So where are rates going? I think most people are kind of under following the news. Rates are going down, and it's kind of a debate between economists of when they're going to start going down, and then how much they're going to go down and at what pace. So most economists are kind of this feeling that the Bank of Canada is going to start. They were originally saying kind of June. Back in November, I was saying about a year from now is when I expect it. So that's third to fourth quarter. I'm still expecting that's when rates are really going to start dropping. Although most economists disagree with me. They think June is kind of the aggregate of the expectation, so that the first rate drop will be June. I think it'll be a little further back, but most economists are kind of predicting that by the end of the year, the Bank of Canada overnight lending rate is going to be 1% lower than it is right now. So this is the path that rates take down to. So as we see that, we know that rates are going down. So this is the bond rates. This isn't the overnight lending rate. So the bond rates or the fixed rates are based off of bond rates, and the bond rates usually predate. They move ahead of what the Bank of Canada is doing, in part because they're predicting it, what the Bank of Canada is going to do, but in part because they're watching inflation. They're watching the same numbers that the Bank of Canada is doing, but they don't have set dates. They could move whenever they feel like it. So that's what our fixed rates are based on. But this is how they go down. So this is one of the reasons why you want to kind of make sure that if you're actively looking at buying sometime in the next year, then you make sure you get everything lined up and you can pull the trigger on rate holds, which is something that's happening today and tomorrow, because we happen to be, so it's, I look at rates as it's a ball bouncing downstairs, but at any given time, there may be an upward trajectory of rates, which is what we're dealing with right now. The bond rate has gone up, so it's been slowly going down, but it's about 40% higher than it was 2.5 weeks ago. So we're kind of in this period here. Yesterday, a lender started announcing like, okay, that's too much. Now we're having to adjust our rates up. How long that'll last till the next set of economic data comes out, they start going down again, who knows? But it's possible, like rates don't necessarily, if you hear rates are going up, it's not the overnight lending rate, it's probably the fixed rates. As you hear that there's a difference between what the Bank of Canada sets for prime lending rate and then what lenders give for fixed rates. I'm hearing a lot of this lately, and I know that Santhosh is going to be he's actually going to be giving some examples of properties that they've actually purchased with their clients over the last month or so. And they do cash flow. So it depends what you're looking for. So if you're looking for just straight cash flow, then there are still cash flow properties out there, even at today's rates and prices. If you're looking for a combination, something with some appreciation, something you'd maybe tear down and build an infill on, where you've got some future upside potential, then it's a little bit more challenging, but they're still out there as well. But I'm going to be basing it because I have a lot of clients that are in that. They're looking to buy properties that they're going to hopefully tear down and turn into something else 3 to 5 to 10 years, whatever that may be. And sometimes those are different types of properties with a little bit less cash flow. And we're probably going to do a presentation on the differences between those two at some point in the future. So I've taken kind of one of those neighborhoods and the price range in the neighborhood. Typically you need the bigger lot in the older neighborhood. And I've taken a $625 price with a legal suite, 20% down, $500,000 mortgage. And then I've kind of put in there what you're going to likely get for rents on a property like that if you're paying $625 for it. So I've got a gross rent of $3,800, and I've thrown in some typical expenses. I've got a net monthly income before mortgage payments or financing of $3,010. So here's the dilemma that we're dealing with a lot of people right now. So this is something that you guys might run into if you're buying in the next little while. So right now, you can get a 5-year fix for a rental property. So it's conventional, 30-year AM, all the things that make it, like if you're buying a principal residence right now, you're even with the increases that have started to happen, you're still like 509. Is probably the going-ish rate for CMHC insured property. Now you've got to pay a premium to get that, but for a rental property and a 30-year amortization, that's about the right property. I think Santhosh did his numbers on 6, which is good because by Friday it's going to be 6. So here's the mortgage payment on it, $2,900. Well, if you recall the $3,010, there's $108 in cash flow a month. Not very attractive for having to deal with buying a rental property. And so you look at that and go, it's not really very much cash flow. And it's true, it isn't. But at the same time, we're also using peak interest rates to for those numbers. So we're saying that like any of my properties that, like, I am somebody who typically takes fixed rate mortgages simply because I have a large enough portfolio. I don't want it all increasing at the same time. However, so for outside of the last 2 years, the preceding decade, I never took a variable rate. Everything I took was fixed. However, I've got 4 variable rate properties right now because I'm not going to lock in at these rates. These are what I consider peak interest rates for the time being anyways. So I'm saying to people, like I'm having the same conversation with everybody. And it's like, well, if you take a variable, it's unique because usually you take a variable with hopes that you're just going to pay a lower rate. Well, we've got an inverted yield curve right now where short-term rates or variable rates are actually higher than the fixed rates. That's not usual. So the idea is that you take the variable rate to give yourself 6 months so you can lock in after rates have started coming down. So people typically understand that part of the concept. Then, what's the variable rate? Okay, it's currently about 7.2. That's a give or take. That's about what you're going to get for your depending on what lender you qualify at. That's about the rate you're going to end up getting. So that puts your payment far above what the net income is. So now you're actually losing $350 a month. So people are having a tough time getting their head wrapped around the concept of like, do I really buy a property where I'm losing $350 a month? It's like, well, you are, but the idea if you agree with the concept, and there's certainly no guarantees about what's going to happen with rates, is that you're actually taking, it's 6 months, so you're overpaying. It's almost like you're paid a $2,000 fee for the right to lock in at summer rates, basically, rates of what they're going to be in August. Let's say by the time you close, take 6 months, maybe it's 8 months, maybe it's 5, but it's basically kind of a short-term fee so that you can then lower your rate so that you're making $350 a month instead of just 108, and then you're making $4,000 a year. If you have 10 properties making $4,000 a year plus another $4,000 per month in principal pay down, all of a sudden you've got a portfolio that starts to make sense. So the reason I'm kind of spelling this out the way it is, and I'm just using 5%. Outside of the last year and a half, a 5% rate would be, the preceding decade, this would be considered a crazy high rate. I put 4.5, but I'm actually using this for my metrics. If it got down to 4.5, maybe you'd have to wait a little bit longer for that. But then you're looking at $6,000 a year in income. I'm still using the 5. I'm going to be err on the side of caution. I definitely don't think we're getting back into the 2s anytime ever, to be honest with you. But I think it's a fair assessment to say this is a reasonable expectation. Again, absolutely no guarantees about what rates are going to do, and we're never getting back down to the 2s. But these two numbers are based on, here's what we think rentals are going to look like over the next, at least the 5 to 10 years that you're going to own it. This is probably the cash flow you're going to be making, even though in the short term, it means you're going to have to swallow these high rates that the Bank of Canada used to try and really tamper down the inflation. So this, and the reason, the simple math to do that is if you're paying this is 1.5% above prime, so the rates don't have to drop that much for you to break even on this math. If rates drop, there are 10 6-month periods in a 5-year term. So if you're overpaying by a full percent, for example, rates only have to drop by 0.1% for the preceding 5 years or the subsequent 5 years for you to break even on that. So this strategy of taking a 6-month hold and making the bet that rates are going to go down doesn't take a lot to pay off. It does make it hard when you're swallowing these numbers, knowing that you're buying a property that you're going to lose money on, because it just never feels good to do that. And people in Toronto, Vancouver, they're used to that. They're comfortable losing $800 a month, even when rates were at 2%, because they would say, oh, it's okay because I'll just refinance and pull out 10 grand to make my payments every few years. They were okay having a portfolio of properties all losing $1,000 a month, and it just shocked me to no end. And I haven't talked to any of those people since, but it's just my colleagues that own property in Vancouver, and that's just what they had to do. They had to buy properties that were negatively cash flowing significantly, and something we're not used to. But they were cash flowing when rates were at 2.1%. They were negative cash flowing. So I can't imagine where they're at now. Not only do they have to sell, because they'd have to come up with likely over $100,000 a year in cash flow, they're going to be selling in a terrible market at the same time. Although I think it's largely about to change across the country as well. So this is Santhosh's now.
Anthony.
Oh, you're doing it?
Yeah.
Okay.
Okay, so we'll switch gears in the same line of events. We'll quickly cover rental market because that will kind of tie into the cash flow situation that we have. So like Layne's talk about, the interest rates are high now, but they are expected to go lower. So when we run our numbers, we still run them with today's rates, and we try to be at least break even on cash flow with today's rates. But the reality of it is they're expected to go down. And on the other side, the rents have gone up significantly. And I think they'll likely keep growing, and I'll kind of illustrate why. So first statistics I have here, this is a CMHC rental market report, which is based on rents from September 2023. So it's fairly recent, but it's not today's rents statistics. And they base it on September because that's typically one of the buzziest time for rental market. So vacancy rates here are really interesting because Calgary in the last few years had pretty high vacancy rates compared to the rest of the country. Not so much anymore. We are around the same as Toronto, right? And the only lower market of the big cities is Vancouver right now. So, 1.4% is very low. Last year was fairly low already. And sorry, it's October, not September. Close enough though. Went down almost by half, right? It's a big drop. That being said, it's easier to build in Calgary than it is in most other cities. We have a big proof of that here. You know, when Layne was talking about, oh, we're behind on catching up with supply of rental properties, it's true, but we're better than most other markets at building, right? And that's a massive difference. 6.2% increase in rental supply. And that's with change in universe that they call. So it's purpose-built rental. So that's not someone that has a house that they turn into a rental property. It's something that's built to be a rental property. And again, it's much higher than any other market. Now, why is Toronto at minus half? It's mostly some older buildings that are probably being demolished or replaced with other type of properties. And it's hard to build in Toronto, as you can see, like they're not really adding supply right now. Calgary is, but again, not enough to keep up with demand. Rent increase, and that kind of illustrates what I was just talking about. Even though we've had an increase in supply, our rent increase was really strong. In fact, we had the strongest rent increase year over year in the whole country. There's a few reasons for that. We don't have rent control, so we don't have caps on rent increase, right? Where a lot of those other cities like Vancouver, Toronto, Ottawa, Montreal, they all have rent controls. So often the existing tenants can't be increased a whole lot. It's only on the new rental property or the new leases that you can actually get market rents. We don't have that problem. So that's part of the reason why it's gone up. But another part of it is we've had a lot of people moving here. We've had really high net migration. So that's been a huge reason why as well, right? But that's huge, right? And that helps in the cash flow situation. The numbers we have today are starting to look better than the numbers we had last year because the rates are pretty comparable at this point in terms of interest rates, but we're starting to see better rents, right? That being said, it is seasonal. So if we look at trends today, they might not look that much better because it's winter. But, you know, if we look at October again, compared to October the previous year, we're almost 15% better. And as the summer rolls in, I expect we're going to start to see rents go back up as well. And this one's interesting as well. So this is the vacancy rate changes, right? And for Calgary, it's actually interesting because as you can see, so average rent, is the red line, and then vacancy is the blue line. Our rent's actually gone down quite a bit, right? And not a lot of markets in Canada have that. And as you can see, we had that in both of our oil and gas downturns, right? 2008, we had rent drops around 5% for 2 years. And then our last downturn, right, 2015, 2016, with significant rent drop, right? I think total was around 20, 25%, right? Because we had a few years at 5, 10% rent drop. And then we had essentially flat rent all the way to 2021. So once we started to see rents go up, 2022, really, we were only back to what the rents were before the downturn because we essentially canceled the drop in rents, right? Now we're starting to see rents that are higher than the downturn, but took some time. So, a lot of tenants are shocked with their rent going up 10, 15% a year. But a lot of them are kind of quick to forget that they also had a freebie for 5 years of rents not going up, right? But of course, it's easier for tenant to go up 3, 4% a year than to go up like 15% in one single year, right? But it kind of shows the affordability picture. That's one of the reasons why, even though the rents have gone up so much, they're still some of the most affordable in the country because again, they were flat for quite some time and even dropped. So that's kind of the average we're at right now. CMHC has kind of two ways to look at market trends. They look at 2 bedrooms in purpose-built rentals. So those would be like, let's say a 40-unit building on one title or 20-unit building on one title. And they look at condominium apartment market, which would be like one title for one rental unit. The reason to do that is they're a bit different. The purpose-built rental are typically operated by larger landlords. And the condominium market is typically operated by, you guys like mom and pop landlord. And in some markets, the gap is very wide because of rent control. Right? It's harder to raise the rents of the purpose-built rental in a lot of markets. Not so much the case in Calgary. So Calgary, we can see it's like $100 or so. I was looking at Toronto. I think we're looking at $700 or $800 gap. Like it's massive gap between these two. So anyway, long story short, 2-bedroom average across the whole city were around the $1,700 to $1,800 mark for an apartment, 2-bedroom apartment, which again is up by 14% year over year. Some highlights of that I thought were really interesting for that CMHC report. That rent increase is the highest year over year in all of Canada, and it's the highest rent growth since 2007 in Calgary. And some of those might remember 2007 here, it was like a really strong oil and gas boom. We don't have a really strong oil and gas boom as we're talking earlier, right? So it's mostly driven by demographic boom and other industry, right? Like Layne was talking about, like we've got diverse industry now that they're booming. So now we'll talk about what can you buy today that still cash flows, right? Because it is harder to cash flow with the current rates, but it's not impossible. So for the most part, as a general rule, we'll be kind of in the duplex to detached house kind of product. And I'll have Santhosh talk about kind of ways to improve the cash flows of these units. But for the most part, that's the kind of products that work, and usually with basement suites. Why 2 units? Why basement suites? Well, just to kind of illustrate my point, I've got the example of a detached bungalow for $600,000 with a 3-bedroom main floor and 2-bedroom finished basement, right? So nice basement, usable space, but 1 unit. Right? So it'd be a 5-bedroom house, essentially, that you would buy for $600,000. Right now in Calgary, for the most part, you can rent that for about $2,800, or you could buy for about $50K more, right, over a finished, nice basement, get a legal basement suite, which would still be the same basement, but have a kitchen, cooking facility, all that. Now you can rent the main floor for about $2,300 and the basement for about $15. Now your total rent is $1,000 more. So essentially you're paying an extra 8% in purchase price, but you're getting an extra 35% in rent. So the numbers just add up better, right? Especially if you're looking after cash flow, it's kind of a no-brainer. So I'll pass it on to Santhosh. He's going to talk about different ways that you can improve your existing cash flow. If you're looking at the future property, how you can make it cash flow better.
Okay, so got a few different ways here on the screen that you can improve your cash flow if you have an existing property and you're kind of struggling to make it cash flow, right? You could switch to room rentals. Now there's a disclaimer here. It's very management intensive. It's a high risk, high reward, because there are a lot of tenants, there's a lot of turnover, and there's a lot of wear and tear on the property if you do room rentals. But it is a way to improve your cash flow if you rent by the room. Another way would be you could add a basement suite if you don't have one, or you could legalize if you have an illegal suite and do some cosmetic updates. The next one would be adding a garage. A lot of times we really like this approach. It's a very simple way to increase the cash flow and turn a property that's negative cash flow into positive cash flow. Okay. I'll talk a little bit more about this in the upcoming slides. And then, of course, you could do strategic upgrades, right? So you want to do upgrades that actually would raise the rent. You don't need to go crazy with the improvements. You got to be strategic about what you're doing, right? And what you're doing really depends on what your rent comparables are. You want to make sure you're equal or better than your competitors so you can command a premium rent for your property. And of course, you can always switch gears. If your long-term rental isn't working out that great, you could always try a short-term rental approach. You could do corporate rentals. So there's options. And most of these work with detached, semi-detached properties. But what about a condo? Now, all those options just disappeared, and you're left with short-term rentals and just doing strategic upgrades. And this is why we're generally not a fan of condos or townhouses that have condo fees associated with them. And short-term rentals in particular, the city just introduced more regulations and kind of hoops to jump through if you want to do a short-term rental. And it gets even harder if the condo board does not allow short-term rentals, which leaves you with only one option if you have a condo or townhouse. Okay, so you essentially limit yourself as far as being able to adapt if there's a market downturn or if you need to get your property cash flowing. So why do we like garages? I talked a little bit about the garage earlier. So it's often a very easy way to improve the cash flow. There's low maintenance with a garage. I mean, if you think about it, there's only a garage opener, the door really, and a light bulb maybe in the garage. So there's really not much, and there's low turnover. Vacancies are not often. I mean, I've got garage units of my own. Anthony's got a few garage rentals as well. And our experience has been once people move their junk in, they never move out. Right? It's just not worth the hassle for most tenants. So the turnover is really low. And the build cost of a garage, which is typically about 30 to 40 plus K, depending on how big you're going with it, can usually be done as a purchase plus improvements mortgage. So it can be amortized into your mortgage payments. So that's kind of the typical pricing, 30 to 40 for a double. If you're going bigger, it'd be 50 to 70. And how much does it go for? So double garage is going to go for about 400 if if there's no insulation, drywall, it's kind of bare bones garage. $400 for storage. And if you have heat in there, $500 to $550. And then likewise for the triple. So if it costs you $40,000 to build a double garage and you rent it for $400 a month, you're meeting the 1% rule, which doesn't really happen in Calgary for the most part, right? But it works on a garage. So here's the first case study that we helped a client with. And this is a half duplex in Beddington. And we just purchased this, well, the client purchased this in January, so a month ago. It's in Beddington, 2 bedrooms, 1 bathroom up, and 2 bed, 1 bath down. And this one was already legally suited. And the condition of it was kind of average. It was a 70s home, so kind of average finishes. And here I have the numbers breakdown. So the rents over here of $1,900 for the main, $1,300 for the basement. And I've got all the numbers here, property taxes, insurance, which is typical for a home of this age. Utilities tenants will pay, and we always budget about $200 a month for repairs and capital improvements. So things like budgeting for your roof, windows, and that sort of stuff. Okay?
Depends on the property, right? You'll sit in a detached, will have a bigger budget. If the property is older than yours.
So, and here is the purchase price. So in case anyone's confused. And this assumes a 20% down payment and you're paying 6% interest rate with a 30-year amortization. And you can see the cash flow comes out to $216 a month, as is, at today's rates, using 6%. So it's not impossible to find a cash flowing property. It's still possible. Now, was it easy to find this property? No. We went through multiple offers with this client. We lost on multiple properties, but eventually one worked out, right? So in this market, you have to be patient. It's not easy to buy in this market, and we experience that firsthand with the number of offers we write, but it's doable, and you can still cash flow. Now, for this situation, what if we added a garage at a cost of $30K, right? We saw the previous cash flow, but how does it look now? So now we've added a garage in, which brings in an extra $400, and I've bumped up the purchase price by $30,000. Now you can see how much the cash flow improves. It's now $461. So that's a very simple, quick way to bump up the cash flow rate. So you notice on the previous slide, I had nothing included for property management. Assume you're investing from out of province or you live far away, you need someone to manage this for you. And you hired a full service property management company, which means all you get is a rent payment in your account. You don't have to deal with anything else. You don't even have to worry that you have a property, okay? So if you went down that route, it takes a huge chunk of the cash flow out. It's $432 a month. Property management is typically 10 to 12% of gross rents, okay? So it of course affects your cash flow, but on a semi-detached, you're still cash flowing positive. I mean, for the most part, you break even, $30, give or take. And I'll talk a little bit more about property management and what other alternatives there are to save on that side of things. So here's the next example. So this one, the previous one was a semi-detached. This one is a detached property. Now this one had an illegal suite. This one we purchased in November last year for $540, also in Beddington. Condition was pretty average. It was kind of updated over the years with a few things, but it wasn't new and shiny. Okay? So because it was an illegal suite, the clients wanted to obviously legalize the basement suite right away under the amnesty program that the city has right now. And the cost is about $15,000 from what we heard from them. And these are kind of the few things that they have to do, like add a parking pad, smoke alarms, drywalling, a bunch of other repairs. So that's how the rents are looking after they did all the work. And again, we've got the repair budget, all the numbers here, and the purchase price. So they paid $540, it cost them $15, so I added the purchase price is $555. And on a detached property, you can see the cash flow is not as great as a semi-detached. And it makes sense because with a detached property, you're getting more land. There's generally a higher purchase price associated with a detached versus a semi-detached. However, the rents are not going to be that much more just because you have a detached property. So that's why detached properties generally cash flow less compared to semi-detached. Now, on that same property, because we were barely cash flowing, just a little bit in the positive, I think it was $44. If we added a double garage for $400, now our cash flow, and then a bumped up purchase price, now our cash flow is $290, which is pretty decent for a detached property with today's rates, right? So if rates started going down from 6% down to say 4.5 or 5, then you could see how the numbers would change pretty nicely. Now, if you added the double garage, but you needed full service property management, that's going to take a good chunk of the profits out. So now you're actually negative cash flow in this situation. Okay. So the moment you include full service property management, you can expect a lot of properties to take a hit on the cash flow. If it's a semi-detached property, you'll kind of make it out okay, but on the detached properties, you'll often be negative if you have to go with a full service property manager. Okay, so here is the last example that I had. This is a semi-detached with a legal suite, and this one's in Canyon Meadows. Okay? And this property just went firm a few days ago. So if anyone's been browsing the MLS, you might have came across this listing. And this one was in average condition, had some updates over the years. And this property was tenant occupied. So there's currently tenants in place, and the buyer is assuming the tenants with their fixed term leases. Okay. So I've kind of used the same rents that they're getting right now, which is $1,800 for the main floor and $1,500 for the basement. And all the expenses are here, and the cash flow is $247 on day one, as is. But we know that we can raise rents, at least on the main floor, by at least a couple of $100 because it's in fairly decent shape. So once you raise those rents at today's rates, you're still going to be cash flowing pretty nicely. Again, now if we add a garage, cash flow is even nicer. Okay. So on that last property I showed in Canyon Meadows, how does it play out in the long run, right? It's important not to just look at your cash flow on day one or month one. If you want to kind of look at the big picture, right? Because cash flow is only one component of the whole thing. So assuming our market grows at a very modest 3% a year, rent grows 3% a year, and your expenses are climbing at 5% a year. You can see how your loan balance goes down, your equity builds up over time, your total return. And your 10-year annualized return is 40.7%, which is a pretty nice number. I think I'll take that over stocks any day. So assuming the market tanks, it's doomsday, everything's not going well, there's zero appreciation, okay? And the entire time you've owned this property, not a speck of appreciation. Rents have only grown 1%, and your expenses are continuing to grow. That's still a really nice 17.4% annualized return, okay, over the 10 years. It just kind of goes to show you the power of real estate, really. So condos. A lot of people always come and ask us, thinking of buying a condo as an investment property because, I don't want to deal with the maintenance and like the headache of, dealing with snow removal, lawn care, and that sort of stuff, right? So we generally discourage people against condos. There are some situations where it makes sense, but generally it doesn't, and here's why. So this was an example of a property on market. I'm not going to name the address. It's in Sage Hill. It's listed for $375, 2-bedroom, 2-bathroom, and it's got condo fees of $495 a month, which is fairly steep considering it's a 2017 build. So here's how the numbers look. Because you only have one unit, the rents are about $2,000 for a unit like that in Sage Hill. And of course, you've got your usual stuff, property tax, insurance, maintenance, and condo fees, which is pretty steep, $495, right? And you could look at how your cash flow, how terrible this cash flow is. You're basically bleeding money every month, right? Now, sure, if interest rates changed, that would help, but it's still going to take quite a bit for you to at least break even. Now, you might be saying, okay, well, condo fees are $495. I'll just find a condo with lesser condo fees, okay? So let's see how that situation works out. So now, assume our condo fees for this property is only $280, which is pretty typical for a newer build. So same rents, but now $280, and you're also going to be a frugal DIY landlord. So any repairs, you're going to kind of fix it yourself and save on the repair and maintenance costs. So let's just say $100. That still puts you in the negative $400 a month. Okay. So regardless of how you look at it, the numbers don't look great. Right?
One thing to point out too is, although you can find new build at that kind of condo fees, they don't stay at these kind of condo fees, right? Typically within 5 years or so, we see them go up to the more typical like 450, 500 a month.
That's
you still have
yeah.
to run your number at a higher
Yeah.
condo fees. So.
Yeah, that's a good point, because a lot of newer condos have low condo fees to get people to buy into the building. Okay, now once the developer is sold out, then it's up to the condo board, and then the condo board's like, okay, well, we need to up the condo fee to have a healthy enough reserve fund, right? So that's typically what happens. So yeah, your break-even cash flow is at a 3.5% interest rate with 20%, assuming rents and condo fees stay the same. Here's another example. This one is downtown. So some people may be like, well, maybe downtown condos would be better because, why not? So this one, again, is property on market, $298,000. So relatively affordable. 2-bed, 1-bath. It was renovated in a 2002 build. Okay, and that's the condo fee. Again, the rents are going to be around $2,000. The rents are not that different between the suburbs and downtown for the most part for most condos, unless there's extra amenities and whatnot involved.
And that's an older building too, right? Because it's 2002 building.
And again, even with these types of numbers, the cash flow is still almost negative $200 a month. Okay? And what can you do to really change that number? Not much, to be honest. You could do some strategic improvements. You might be able to update a few things, refresh the unit a bit, but you might get maybe $100 more in rent, which still isn't going to do much in terms of making the property profitable from a cash flow perspective. So I want to talk a little bit about property management. So I showed some examples if we included property management. So if you went with a full service property management company, it's generally about 10 to 12% of gross rents every month, right? Plus, there's often extras included, extra fees included, such as a tenant finding fee, which can be anywhere from half to 1 month's rent upfront, along with things such as you have to use their preferred contractor, things like that for repairs. There might be markups on those as well. However, self-management is a really good way to start off. It allows you to learn a little bit more about property yourself, and especially if you're a newer landlord, you kind of get a feel for how to property manage. Okay, and if you're remote, say if you're living in Edmonton, investing in Calgary, or even in Ontario, most things can be run remotely. Myself and Anthony, we self-manage our properties. A lot of things we handle remotely, right? Your tenant's going to text you or email you. You can sign leases digitally. The only time you need to go to the property is if your tenant's doing, if you have to do tenant showings, or if you're doing move-in or move-out inspections, or if you just need to check on the property, right? Which is not that often. You're not going to your property every week, right? So there are companies that offer a la carte tenant services, so you can pay them by the hour, kind of like a runner. So if you need someone, they'll just go and check on the property for you, and then it's kind of like a flat fee for that. So it works out to be a lot cheaper and economical for most clients. So that's typically the route we would recommend. So I'll let Anthony talk about this last slide.
Yeah, so we spend quite a lot of time to talk about how to get the property to cash flow more, right? But I think something we need to address is, does cash flow really matter all that much? Well, it does to some extent, but it's not the only thing that matters, right? So cash flow is mostly a defensive measure, not a wealth building measure. Yeah. So cash flow is often the smallest part of your total return on investment, but it's the one that keeps you alive, right? Because if you're in a downturn and interest rates go up or rents go down and you've got some healthy cash flow, you can hold that property and ride out that downturn, right? Because we go through different market cycles as you hold real estate, but on the long run, everything ends up working out, right? If you hold it for long enough, you'll get out of that cycle. But if you can't stay alive in that cycle and you're forced to sell in the worst time to sell, that's a problem, right? So that's where cash flow is important, is to keep you alive. Obviously, it gives you a bit of an income and it increases your return a little bit, but it's a very minimal change in your overall return. Like I mentioned here, right? Your cash flow could drop by half. It changes almost nothing in your total ROI. Like that chart that Santhosh was saying at 40% average, if we drop the cash flow by half, it would have been something like 37%, 36%. Like it's a very small change. However, if there's a small change in market appreciation, that actually has a much bigger impact on your overall return. The thing is, market appreciation, you don't control, but you do control where you buy a property and what you buy. And that will determine the property's appreciation for that property itself, right? So buying a property that's going to appreciate a lot is often more important than having something that cash flows, granted that you can stay alive, right? So that's the main thing. It also impacts your mortgage qualifying because that's part of your debt servicing. And that's even more true today than it was before because the rates are higher. It's harder to qualify as the stress test, all these things. The cash flow helps you to qualify. And as you grow your portfolio, it helps you to keep qualifying, right? If all your properties are cash flow negative or even break even in this case, the bank will look at it as a cash flow negative portfolio and it's really hard to keep qualifying. That being said, as you grow your real estate portfolio and add more and more properties, it becomes a lot less important to cash flow on a given property and it becomes more important to balance your overall portfolio. So for example, Layne and I own a property right now that's bleeding money, right? It's losing almost $1,000 a month. Well, it's a property we're going to knock down in the near future to redevelop. And our overall portfolio in both cases is very cash flow positive because we have a bunch of other properties that are positive. So again, the overall portfolio is balanced. It still works out, right? So again, we spent a lot of time talking about cash flow. At the end of the day, if you're new investors, matters more. If you're a more seasoned investor, you have a bigger portfolio, matters a lot less. So something to keep in mind. So thanks everyone for coming.